Unless you've been living under a rock somewhere, you've probably noticed that the prices of stocks, gold, Bitcoin, and real estate have been soaring over the last couple of years. Many are attributing this melt-up to one simple thing, the so-called debasement trade that's essentially forcing people to dump their fiat currency for other assets. But why might this be happening? And should you jump on board? Well, today we're investigating exactly what the debasement trade is, why it seems to be accelerating, and whether this is a lasting market shift. My name is Guy, and if you care about your portfolio, this is one video you can't afford to miss. First up, I must make one thing clear. I'm not a financial advisor, and nothing in this video should be considered financial advice. This is educational content to inform you about the debasement trade and how it impacts markets. If that sounds good, hit that like button and let's get into it. So, what exactly is the debasement trade? Well, it's a straightforward idea with a rather scary-sounding name. It's a bet that over time, mounting sovereign debt and expansionary monetary policy will quietly chip away at the purchasing power of cash and the real value of government bonds. Many investors believe this thesis, and consequently, they don't want to hold idle dollars. Instead, they rotate into stuff like stocks, gold, Bitcoin, and real estate. They don't want to hold fiat currencies that are losing value by the second, so they rotate into productive or scarce assets. That is the essence of the trade. Now, how does that show up across asset classes? Well, let's start with US stocks. If cash is melting a little each year, owning businesses looks better, especially the ones eating the economy. That's part of why the big indices have been setting records while the AI boom rewired expectations for profits and productivity. You don't need us to tell you that Nvidia and its ecosystem are pulling a disproportionate amount of weight here. When investors think real rates will be kept low over time, that's interest rates adjusted for inflation, those AI valuations don't seem so crazy. It's just the market saying that it would rather own a stream of earnings. Then we have gold, the ancient version of the debasement trade, as gold bugs will not forget to mention at any given opportunity. And to be fair, gold does carry 5,000 years of credibility in this regard. When it comes to preserving purchasing power and safeguarding against money printing, gold is a winner. And lately, it's been doing an awful lot of winning, smashing through to all-time highs thanks to a combination of debasement concerns and safe haven demand. Whether your worry is the slow burn erosion of money's value or geopolitical uncertainty, gold is very alluring. Next, there's Bitcoin, the digital age hard money. Whether you see it as digital gold, a monetary network, or just a volatile tech bet with scarcity, its ultimate pitch in the debasement narrative is straightforward. It has a 21 million supply cap, transparent issuance, global rails, and, well, price going up bigly. And that story got louder once mainstream investment pipes opened via ETFs back in January 2024. That unleashed Bitcoin into price discovery, which helped bring it to its recent highs. And then we have real estate, which plays a slightly different role but needs to be mentioned. It's physical, scarce in the areas people want to live, and it's simply one thing everyone needs, a roof over their head. Just ask any millennial who's given up on buying a home. That combination has kept home prices stubbornly high in the developed world, even as mortgage rates have varied. But for those who can afford to buy, and companies operating as landlords, owning property and the income tied to it feels more sensible than sitting on cash that's losing value. So that's the overview. But let's just set some things straight before we continue. First, debasement doesn't mean predicting hyperinflation or a dramatic currency collapse. Most of the time, it looks pretty boring. Persistent deficits, higher costs of living, and a policy bias towards keeping the real burden of debt manageable. And second, this isn't a one-way street. Stocks can correct, gold can stall, Bitcoin can easily drop sharply, and property tends to take a major hit when there's an economic slump. So, the point is not that these assets only go up, but more people are choosing to own scarce and productive things over idle cash because of what they expect policy to do over the long run. When you think cash will continue to lose its bite, you want to own the stuff money is chasing. Okay, we've established what the debasement trade is, but why on earth does it seem to be in overdrive of late? Well, to explain that, we'll start by looking at a term you might have come across recently: fiscal dominance. Simply put, fiscal dominance is an unsexy phrase for a world where big government deficits and rising debt servicing start boxing in central bank monetary policy. When a country's interest bill on its debt swells, the pressure to keep real rates low increases, regardless of what the inflation target says. So, accumulating sovereign debt can force policy trade-offs that lean inflationary over time. Now, we'll mostly focus on the United States here, as it's the primary example worldwide. So, for the US, net interest costs on its debt burden in 2025 exceed defense costs, an alarming milestone that puts the cost of past borrowing ahead of current military spending. For the US in particular, that is remarkable. It's probably not a one-off either, as official stats from the Congressional Budget Office project interest staying heavy for years. Bonds have been signaling that tension. Even as traders price in rate cuts at the short end, long-dated yields have proven sticky, reflecting fiscal and inflation concerns. In other words, investors want extra compensation to hold long-term bonds when the issuer is borrowing a ton and inflation is still a risk. It's not just the US that's facing a serious debt burden either. The IMF's latest tally puts global debt just above 235% of GDP, barely off the pandemic peaks and largely driven by public borrowing that's drifting higher again. Heavy sovereign balance sheets in advanced and emerging economies alike make the debasement trade instinct feel pretty rational. So, put those factors together and you get an explosive combo. Swollen interest bills, bond markets that are charging more to hold long-term paper, and a global debt load still towering. In this world, cash feels less cozy as people recognize that governments have few tools left but to monetize away their troubles. What's more, it's not just traders and everyday people acknowledging this. The Government Accountability Office, an independent US government agency, calls the federal path unsustainable and warns about the long-run squeeze. You don't have to be a macro nerd to connect these dots to investor behavior. So, the debasement trade appears to be intensifying because debt has been mounting up and the market can no longer ignore it. And, simply put, money printing is the modern country's favorite solution. But everyone knows this, and the thesis argues that people are adjusting accordingly by dumping their fiat. Now you can see why the debasement trade has been so appealing lately as a narrative. But what's the bull case for its continuation? Well, for starters, history shows that when debt gets heavy, governments tend to rely on policies that lower real rates, even with occasional bursts of inflation, to chip it down. This is what economists call financial repression. From there, flows and infrastructure could do the rest. On the stock side, as we've seen, the flows can be relentless. US ETF flows are on pace for a record year, with State Street estimating as much as $1.4 trillion in 2025, an avalanche of automatic buying across broad equity funds. Inside retirement plans, target date funds, which are funds that shift from stocks to bonds as you age, hoover up contributions by default. Vanguard's How America Saves report showed that in 2024, 64% of 401k contributions went into such funds, which are very equity-heavy for most workers. That's basically a standing order to buy equities every paycheck. Congress also hardwired fresh inflows with auto-enrollment rules for new 401ks starting in 2025, pushing 3 to 10% of pay straight into markets unless workers opt out. We also have corporate buybacks. Citadel Securities expects US companies to repurchase roughly $1 trillion of their own shares in 2025. So you get a structural bid under equities that's bigger than most headline flows. Over in the cryptosphere, meanwhile, Bitcoin has built its own interstate system. US-based spot Bitcoin ETFs launched in 2024, and the biggest one, BlackRock's IBIT, has ballooned towards the $100 billion mark. That is all the proof you need that mainstream packaging can funnel institutional size into digital gold. Spot Ethereum ETFs launched soon after, giving another category of savers a compliant way to express a pro-crypto view from a brokerage account. Combine easy access with simple narratives and you get reflexive demand every time there's a discussion around the future of fiat. Then there's gold, which doesn't need new technology. It has central banks. We say that because central banks bought 1,045 tons of gold in 2024, the third straight year above 1,000 tons. That trend clearly doesn't indicate a short-term blip. It looks like a slow, ongoing, official sector reweighting. That's structural support coming from the most deep-pocketed and patient buyers in the world. And for all of the factors mentioned, there's narrative reinforcement as prices soar. Stocks, gold, and Bitcoin are all at or near all-time highs, all while rate cut bets increase and the Fed signals an end to quantitative tightening. It's hard to argue against the idea of owning assets when the benchmarks are setting highs day after day, and monetary policy is set to loosen further. So, the bull case has a lot going for it. Policy that's biased towards softer real rates over time, plumbing that auto-dumps fiat for harder assets, and price action that keeps the narrative plastered on people's screens. In addition to that, on a broader note, the mainstream acceptance of the debasement trade has forced everyday people to recognize some hard truths. Primarily that, over the long term, assets tend to grow with the economy, while inflation eats their idle cash. To be clear, none of this says the path is smooth. It just says the incentives line up. If the goal is to keep debt service manageable without hindering economic growth, a drift towards lower real rates and periodic inflation spurts is the path of least resistance. In that world, dumping fiat for other assets is the default behavior. So, if you align with that bull thesis, you'll be trading your fiat for other assets. And if you want to make the most of trading assets like tokenized stocks and gold or Bitcoin, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. Now, these deals won't be around forever though, so take advantage of them while you can using the link in the description below or the QR code on screen. Now, that all sounds rather convincing as a trade thesis, but what if we told you that none of it is true? Well, the market moves are very real, there's no doubt about that, but the debasement thesis may have little to do with those market moves. Bear with me here. That's because the markets haven't been ripping because everyone suddenly woke up to sovereign debt issues and currency erosion. They ripped simply because we're going through another euphoric phase in the market cycle. You may have heard the mantra that narrative follows price, and that's what some would argue is happening here. For example, stocks have been ripping to new highs almost non-stop for months, and the debasement trade argues that because people are almost allergic to holding cash, they're opting to buy soaring stocks instead. However, this is hardly the first time stock prices have gone parabolic. Particularly in the era of AI hype and roaring prices, it's not difficult to see how emotions may be dominating rational thinking when it comes to investment decisions. And if the rally is mostly a story of sentiment, then you could argue that any talk of a debasement trade is just the label slapped on after the fact. Then there's concentration. If a handful of mega-cap stocks basically prop up the index, it doesn't take a macro thesis to explain new highs. It just takes sustained flows into a few names. The Magnificent Seven, 7 large-cap tech companies, make up over 30% of the S&P 500's weight. That's great on the way up, but nasty on the way down. A similar logic can be extended to gold and Bitcoin and their recent rallies on the back of a hard money narrative. Rather than being driven by fiat debasement, you could argue that these have largely been momentum trades, driven by animal spirits in the markets. As we're all likely aware, Bitcoin in particular is no stranger to a momentum-driven rally. And zooming back out a bit, some would argue that the market-wide melt-up is better explained by liquidity conditions than anything else. Between 2023 and 2025, the Fed pivoted on its rate hiking cycle and began lowering rates. And now, as mentioned earlier, Fed Chair Jerome Powell just said the end of quantitative tightening via balance sheet drawdown may be nearing. So, we're in a situation where the Fed is further loosening up monetary policy into a market where assets have already been ripping for years. Is that a debasement trade, or is it just good old-fashioned market exuberance? But what about the debt story? That's the real question here. Well, it may be receiving more attention than usual, but pundits have been discussing the unsustainable path of US debt for decades. It didn't suddenly appear in just the last few months. That makes the argument that everybody finally noticed debt issues rather thin. If debt anxiety alone were the driver, why did prior years and periods deliver very different market outcomes? Because cycles and liquidity mattered then, and they still do now. And finally, we can look at the DXY. That's an index of dollar strength versus other currencies. A weaker DXY lately doesn't automatically prove intense debasement. It can also read as a natural correction after the monster run back in 2021 to 2022, when it ran from 89 to 114. Markets don't move in a straight line, after all. So, the skeptical view on the debasement thesis is maybe a bit old-fashioned, but not without substance. This melt-up could be just another market cycle boom helped by hyped-up animal spirits, passive flows, buybacks, and liquidity quirks. So, you've heard the bull case for the debasement trade as well as the criticisms of it. But who's right? Well, crazy as it may sound, but there's a good reason to believe both sides are right. Let me explain. At its core, the debasement trade says cash is losing purchasing power over time, and people funnel their fiat into hard assets. Over the long run, regardless of how it feels at any given moment, that thesis is undeniable. In the long run, fiat cash is trash. Now, another thing that's undeniable is the market cycle. And right now, no matter where you place us on the classic market cycle chart, almost nobody is arguing we're in the first innings. Meanwhile, the debasement trade label is getting its loudest airtime precisely while markets are roaring. Price begets narrative. That alone suggests we're nearing a local top, but that's a local top inside a multi-decade positioning trend. Structurally, the incentives that support owning stuff don't disappear. Aging debt piles, periodic financial repression, and geopolitical noise are all slow-moving forces. All the time, cycles do their thing. Liquidity ebbs and flows, earnings whipsaw, and policymakers get pushed into tougher fiscal choices when things really get tricky. So, the practical approach is simple. Expect reflexivity in the short run, whether you attribute that to the debasement trade or not. But be conscious of the long-term trend. If we're late in the cycle, the odds of a big shakeout rise. But if we zoom out, the math still pushes people away from idle cash. That's how you can have a local blow-off top and a durable secular trend at the same time. So, over time, your preferences should be towards real and productive assets. Businesses that earn, rocks that can't be printed, protocols with fixed issuance, and land that serves real demand. Whether you think we're due for a cooling phase or not, the multi-decade positioning still argues for owning things that time can't easily dilute. Well, that's the outlook based on how we see it. But what do you think? Are you firmly in the debasement trade? Do you have any unique thesis of your own? Let us know in the comments. But that's it for today. As always, thank you for watching, and I'll see you next time. This is Guy, over and out. Hey folks, before you go, I have a special announcement to make. If you enjoy the macro-focused content that we post here on Coin Bureau, then good news, you can now watch it on its own dedicated channel, Coin Bureau Finance. So, from now on, we'll be posting our non-crypto content on this new channel that's focused on all aspects of modern finance and investing, while keeping this channel dedicated entirely to crypto. And you can learn more about Coin Bureau Finance in this video here, and you can subscribe to the channel down here. Thanks in advance for your support.